Hi there, I'm Alan Gauld. I'm a Senior Investment Director in the Aberdeen Private Equity team and Lead Portfolio Manager of Aberdeen Private Equity Opportunities Trust, or APO for short. APO was launched over 2 decades ago, back in 2001, and it used to be called Standard Life Private Equity. And really it's about providing access to the private equity asset class to investors of all types and sizes. And throughout its 20 plus years, it's been focused on the European market principally. And we think Europe is attractive, it's heterogeneous, it's difficult to fly in and make deals. So it's all about accessing the best managers on the ground who are often in demand and oversubscribed. And that's what APO offers. I also think Europe's attractive in other ways, such as its strong focus on ESG and the fact that Europe is leading the way in terms of the green transition, which we think is a fantastic opportunity over the long term for private equity. APO partners with a small group of private equity managers through their funds and direct co-investment. And direct co-investment now equates to around 21% of the portfolio and growing. APO has over 650 underlying companies, well balanced by country, sector, maturity. And it also pays a quarterly dividend equating to a yield of around 3.5% at the moment. And lastly, in terms of APO, its long-term performance has been strong. It has an annualized NAV total return since inception of 11.5%, and the trust has grown its NAV in every year since 2010. The media does keep talking about dry powder, so it's worth taking a step back probably to kind of define that. So most private equity funds most private equity firms manage funds, which within that fund, they will make a portfolio of private companies, usually between sort of 6 and 30 private companies typically. Now, these private equity funds are mostly raised on a blind pool basis, which means that investors make capital commitments to the fund when there are no portfolio companies, and they trust the private equity firm to make the investments into these portfolio companies over time. And when the private equity firm makes those investments, it draws the capital from investors. So dry powder is defined as the capital raised by private equity funds that is yet to be invested into private companies. So it's somewhat a barometer for how well capitalized the industry is. And right now, dry powder in the private equity industry is at all-time record levels, with so many new investors being attracted to the asset class in recent years and existing investors who are very happy with the performance, increasing their exposure. So according to Preqin, total dry powder in private equity right now globally is around $1.2, $1.3 trillion. In Europe, it's around $300 billion. And as I say, that is a sort of a high watermark for the industry. It basically means that private equity managers have a lot of money to spend on new companies over the next few years. But I would say our personal view is that fundraising, because of the difficulties in fundraising right now, it's taking longer to raise funds. Funds are getting raised at sort of sometimes sizes that are smaller than the previous fund. We think that the dry powder is peaking right now, and we'll see that come off a little bit as the capital is drawn for new investment. Now, dry powder right now, according to Bain & Co. in their research, over 75% of the dry powder today was raised in the last 3 years. And private equity funds typically have 5 or 6 years to invest this capital. That is their investment period. And so that means there's still a bit of time for those funds to invest this dry powder, but they can't sit on their hands too long. They will need to get out and invest it in the short to medium term. So what does this record level of dry powder mean for APO and APO shareholders? Well, it does mean that competition is high right now. There's a lot of capital there. So naturally, that means that there's a lot of private equity firms competing for assets. I would say, though, that's not really different from recent years. It's been a competitive environment for a good 5 or 10 years now. And most of this capital, most of this dry powder is sitting with the large and mega cap funds. So the real fierce competition is probably more at the upper end of the private equity market, less so in the mid-market where APO focuses. So actually, whilst competition is still high in the mid-market, I'm not trying to say otherwise, what this does mean, this congregation of dry powder at the upper end means that for mid-market private equity firms, there is an obvious exit route to sell their portfolio businesses. They can sell them to trade, which is the most popular route in private equity in terms of exiting. But these large, well-capitalized private equity firms, will certainly have an interest in the successful businesses that mid-market firms own. So it's sort of a two-edged sword, a bit more competition in the mid-market, but also probably more exit optionality as well. And then the second point I'd make about the impact is probably the dry powder. As we know, private equity activity really since the Ukraine war and sort of rises in interest rates has been somewhat muted, certainly relative to recent years where activity has been really strong. There's not been as much new M&A being done as people kind of just pause and reflect on the new financial environment that we're in, that buyer expectations and seller expectations have been vastly different in recent times, and also access to debt financing has been more difficult. It's less available, it's more expensive. And I personally think that this record level of dry powder means that private equity activity can't stay quiet for that much longer. Private equity firms will need to go out there and use this capital. Dry powder is use it or lose it. Once your investment period goes, all you can do is make follow-on investments in your existing portfolio. You can't make new platform investments. So we think that'll trigger more activity in the marketplace. And what that means for APO is more cash coming back. But importantly, probably the more important thing I think here is around NAV growth. So usually when private equity sells assets, they do so at an uplift to the book valuation. And we saw in the last 10 years in our portfolio, that uplift upon exit was around 25% when compared to the unrealized valuation 2 quarters prior. So that helps drive consistent NAV growth. So as activity comes back into the private markets, driven by this high level of dry powder, we should see nice NAV growth from these uplifts upon exit, and that obviously has implications for the share price. So what I would say up front is that we are very confident in the valuations in our book. There's a lot of scrutiny on those valuations. The APO portfolio is a buyout portfolio, so that means that they're companies majority owned by private equity firms that are typically well-established, institutional, cash-generative businesses. So, and those businesses are revalued every quarter bottom up. The thing that really gives me comfort is the governance around private equity valuations. So, as a modern-day institutional-grade private equity manager has a lot of governance around the valuation process. So that sort of negates this idea that somehow private equity managers are refusing to mark down their book. All of the managers in the APO portfolio revalue on a quarterly basis bottom up. All of them report or value in line with international private equity and venture capital guidelines. All of them are in line with IFRS or US GAAP accounting standards. And importantly, all of the underlying investments are audited at least annually by the fund's auditors. Now, you add on top the fact that with APO, our auditors indeed look at the valuations again on a sample of the largest positions in the book. There's scrutiny from us as a manager, there's scrutiny from the audit committee, who we formally present to every quarter on the valuations. So the governance is multi-layered, and the idea that somehow everyone's asleep at the wheel, I think, is somewhat far-fetched. And I'd also say, in terms of the incentive for private equity firms to overvalue, it just really isn't there. Private equity firms typically charge their fees on commitments or on cost, not on value. So there's no kind of fee element sort of driving valuations. And also their performance fee, their carried interest, as it's known, that is on realizations, on cash coming back. That's how that's measured. So there really isn't an awful lot of incentive for a high quality private equity firm to overvalue. So that's the first thing I'd say. The governance is very, very strong. The other thing I would point out is that earnings growth in our portfolio has been quite strong actually over the last wee while. So if we look at our top 50 companies, which equate to around 42% of the portfolio, EBITDA in the last 12 months to 31st of March grew 29%. So that's helping drive valuations as well, the strong earnings growth. Now, why have private equity-backed assets been able to grow that strongly? Well, I would say there's an element of the comparative numbers perhaps being a little bit weak post-COVID. There's an element of that. We have to be transparent about that. But I also think private equity changed an awful lot following the global financial crisis. It changed its focus by sector. Historically, there was a lot of industrial, a lot of manufacturing businesses, a lot of casual dining roll-ups, bricks and mortar retail. And now it's a lot of non-discretionary type sectors. So a lot of tech and healthcare, a lot of consumer staples, essential business-to-business services businesses. And that makes up the majority of our portfolio now. Businesses that have market leadership and pricing power. So that certainly helped. And as an example, 10 years ago, the healthcare sector was 6% of APO's book. Now it's over 20%. So, more secular growth sector focus has certainly come into play. But also, private equity firms as well have really increased their capabilities around value creation. Most firms now have an in-house consultancy, effectively, full of functional expertise, whether that's sales and pricing, whether it's digitization, ESG, cybersecurity, procurement, whatever it may be. They have experts on board on the payroll, and they know the right consultants as well, should they need additional support. So they're a lot more active, and I think that's one of the strengths of the private equity model is the governance model. The fact that private equity firms do, in fact, own the majority of the company and can take an active role, sit on the board, and really influence strategic direction and value creation. And so those are two big differences, the sectoral and also the value creation part. So earnings have been strong, governance is good. The question then is, well, what about the multiple that private equity firms use to value? Surely that's come down with what's happened in the public markets, and it has, but probably not as much as you would think. If we look at our top 50 again, and it's not a like-for-like comparison because the top 50 does change a little bit from period to period, but the value on average, or the median multiple, was around 16 times 12 months ago, and now it's just above 14 times. So there has been a contraction in the valuation multiple in our largest assets, but it's important to recognise how private equity values. So typically they use a basket of listed comparables, similar businesses on the stock exchange, as a sort of valuation proof point. And they apply a discount, usually for illiquidity reasons, to this basket. And then some also include transaction comparables, which private transactions, in the private equity space, to also feed those into an average or a median multiple that they use to value their businesses. And those transaction multiples tend to be longer term in nature, but also businesses that are probably more appropriate in size and growth with the business that they're valuing. And that effectively creates a little bit of a buffer with public equities. And how that manifests itself, the best way to explain it or to show you how this has worked is the fact that over the last 10 years, and in fact longer than that, when a private equity firm sells a business, it has done so at an uplift, which I think shows the conservative nature of the valuations over that time period. So the average uplift in our book, as I mentioned earlier, is around 25% when compared with the unrealized value 2 quarters prior. That's over the last 10 years. And in fact, Bain & Co did some analysis in their global private equity report where they showed over 70% of exits were in excess of the valuation 1 quarter prior. So there's that uplift upon exit, which shows that valuations have been relatively conservative in the buyout space. So I think that there is a fair argument, just to sort of round this off, there is a fair argument, are private equity valuations still as conservative now? And frankly, that's still a bit of an open question. We don't really have enough proof points yet post the war in Ukraine and the change in the markets to demonstrate this with great certainty. But from the exits we have seen, they remain at an uplift. So there's some big exits in Europe with the likes of HG selling Transporeon, with the likes of Nordic Capital selling the binding site, with the likes of CVC selling April, all at uplifts to the unrealized valuation 2 quarters prior. So it seems to still be there, but we need a few more proof points in the market in terms of exits to come away with any sort of conclusion. So in summary, long-winded, but in summary, very confident on the valuation of the book. The question now, which I think is a valid question, is whether private equity valuations are as conservative now as they were in the last 10 years. And hence, will the uplift upon exit be 25% going forward, or will it be something a bit more modest in the sort of 10, 15%? And that we don't have a definitive answer to, and only time will tell.